Hello everybody. So today I want to talk about a small cap I own, which is up 15% in the early market here, and they reported great earnings. But one thing that caught my eye, and which really makes me call them CashMedix and not CorMedix anymore as a joke, is the 60% EBITDA margin. And the question is, am I calculating that right? 39 million of revenue they released, right? So they beat by 3 million. That's great. But on the adjusted EBITDA, they achieved almost 24 million of adjusted EBITDA. And so I calculate that to be a 60% EBITDA margin, which is absolutely insane. We're talking about NVIDIA, we're talking about Visa type margins for a small cap that literally just started. They literally just released their product. This is the third quarter of sales. They've only had 3 quarters of sales. What is the product really quickly? So the basics of the product is kidney care. So patients who are in the end of their kidney disease journey, unfortunately, they have to get hemodialysis. Hemodialysis is 2 tubes that are put in your upper torso right here, and they have to go twice a week, sometimes more, sometimes less, but they have to go twice a week to a dialysis center in order to get their kidney flushed. I don't know if I say that right, but to get their kidney, flushed. Like you remove the waste, you remove the fluid, and so these catheters are placed. And so what happens often is that if you don't have a solution in there, if you don't have a catheter lock, if you don't have a solution in there, you're going to get infections. And these infections are very, very costly for Medicare. They are very costly for Medicare, between $75,000 and $100,000 for an hospitalization. They're also very deadly. If you get an infection at a hemodialysis center, your odds of dying are actually very, very, very high. And so that is why, contrary to a lot of drugs that I cover on this channel, that is why Medicare is actually just fine paying for 2 hemodialysis vials, 2 catheter lock vials each time a patient goes, so that they can avoid that $100,000 hospitalization. Also, dialysis centers are strongly incentivized to limit infections, right? The reimbursement schemes that they get from Medicare is all about, did you limit the infections? So everybody's essentially incentivized to get this catheter or lock, which is a simple solution called DefenCath that you put in each tube, and when the patient goes on, they have a solution in each tube and they don't get an infection. And the solution, from what I remember a few quarters ago, they said it was about $200 for the solution, which again, you have to pay $200 multiple times a month, but that is nothing compared to the cost of an hospitalization and the risk. And the average patient stays on the catheter lock solution about 9 months. Why 9 months? Because unfortunately, typically, after 9 months, unfortunately, you pass away. So anyways, it's kind of end-of-life care, kind of a sad topic, but still an important business, a great business if you ask me, and frankly a business that is useful, because you save a lot of money for Medicare, and you also avoid patient early death. You avoid patient early death from infections. So let's talk about the revenue trajectory of this business, because I think a lot of people like this business. And so in Q1, they barely had no sales, like $100,000. In Q2, Q2 2024. So in Q1, they had no sales. Q2, they had some sales. And Q3, Q4, you can see it has had explosive growth. So now we were at 31 million in Q4. Now we're at 39 million. And is this going to continue? Well, I think it's going to continue. In the call, so this is what I read in the call, they've said twice that they expect a modest revenue decline in Q2 of the year, but they've updated and they said, okay, well, now it looks like we're going to be in the upper hand of our first half guidance. and that we're not going to have nearly as large of a decline. So maybe they're going to have an over $32 million quarter in Q2 of 2025, and they've telegraphed that to the market so well. They've said that multiple times to the market. This is why the stock went down to like $5 not too long ago, because they telegraphed that and they let the market know that. But, is that even going to happen at this point? And they say the reason for that is that some of their customers, of course, pre-ordered and they ordered too much. Okay, this is a classic thing in all of the businesses I analyze that don't deal with the end customer. You have at some point a customer that orders too much. And so I don't know why they did that, but they think on Q3 on Q3 of 25, the sales will be able to track more closely the use of the product. So we'll see. But I think all of this argument, all of this thing is moot, because this business is very simple. There's essentially two very, very large providers of dialysis in America, Fresenius and DaVita. These are the two main leaders of U.S. renal care, and they've onboarded one of them, and they haven't onboarded the other. And of course, they don't really tell you which one it is, so I have no idea which one it is, but I'm assuming it's not one of the small ones. And they're very excited about onboarding another big one, right? And so you can see in the call, the CEO talks about a large variable for our potential full-year financial outlook is the timing and scale of uptake by our previously announced large dialysis operator customer. Right, we've seen increased level of communication and planning related activities with medical operations and staff and the customer. To that extent, we're optimistic that our target for mid-year 2025 implementation starts. So they will start selling to one of those large customers. Now, who is that large customer? Is it Fresenius? Is it DaVita? Is it Satellite Healthcare, Innovative Renal Care, Northwest Kidney? I don't know. But they're going to get one of these large customers. And really the number of customers to sell this to is well known, right? It's a short list. And so maybe over a very long run, we're not going to have the best growth. But over, say, the 1 year or 2 years, I think we're going to have outstanding growth as simply the renal care adopts the FDA-approved catheter lock solution, which is the main solution. So anyways, valuation. Let's talk about valuation, because, of course, why am I in this stock, right? On this channel, one of my buckets is inexpensive stocks. I'm in this stock because this stock is dirt cheap, so dirt cheap. Tough to believe how cheap this stock is. Most analysts predict at least 150 million in 2025 for that stock. Some as much as 250 million for 2026. And actually, if you look at the analyst number out to 2030, some analysts predict this company could do $1 billion in sales. Keep in mind, this is a $690 million market cap after the pop, right? And performance year to date has been 93%. So the stock has done really well, if you ask me. But the key question is, what growth number do I put in my spreadsheet? Do I put a 180%, which is the number I've had historically, or do I put less? Well, if I put 180%, which I still think is realistic, you would get a 0.05 on enterprise value over gross profit or revenue growth, and you would get a rule of 40 of 240. And why is the rule of 40 so high? Because if this company had no growth whatsoever, with a 60% EBITDA margin, they print so much cash that it's enough to take them over the rule of 40. That is how outstanding CorMedix is. They make a lot of money on this product, right? And then, of course, if I even put 100%, so let's assume I'm way off, and let's assume they just double their sales, which, by the way, they had $81 million in sales. If you just assume that they'll repeat Q1 4 times, you're at 156 million, right? So you're almost at 100% growth if they just repeat what they did in Q1 and stop the growth altogether. So I think they're going to do more than 100%, because if they just grow like Q1 for the next 4 quarters, they're at 100% already. So the point is they're already at a double, because they're gonna be at 160 million, and trailing 12 months is 81 million. So the point I'm trying to say is that even if I put 100%, which would be unrealistically low in my view. I get a 0.09. I get a stock that is slightly cheaper than HIMSS. There you go. And a rule of 40 of 160, and a company that is just literally printing cash. And they have potential other businesses like the feeding tubes, like what is it, perinatal feeding tubes, big market. TPN is what they call it. For TPNs, when you go to the hospital, there's infections in there too. They're hoping to add on that market, and that market is probably another $200 million in sales if they actually introduce catheter lock to hospital infections. So I think this company has a great product. And of course, it is also very, very cheap. And there's not a lot of companies that have a great product and that are at the same time very cheap. The stock is up 15% on the day, but keep in mind that this is a small cap, and it got battered in April. Like, it is crazy. The market tends to dispose of these companies so quickly whenever there is a macro fear. So Microspace is quite lower than this. I wouldn't buy at this level, but this is definitely a stock that is going to be on my radar. And if it drops, you bet I'll be interested in buying that one. So anyways, this was not financial advice, not investment advice, not catheter advice, no dialysis advice. This is just entertainment. I mean, you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.